Hello everyone, I'm Erin from WebNazar, your digital lens on everything trending. Today, we're diving into another important story, idea, or innovation shaping our world.
On the morning of June 23, 2026, South Korea's KOSPI index plummeted 10% overnight. The sell-off was sharp enough to trigger market-wide circuit breakers, forcing the Korea exchange to suspend all trading. That panic quickly traveled west. By midday, India's BSE Sensex had dropped nearly 900 points, erasing roughly 4.6 lakh crore in investor wealth in a single session. By the time the opening bell rang in New York, the damage was widespread. Major tech names, from Nvidia to the newly public SpaceX, saw their valuations take immediate multi-billion-dollar hits. This crash followed a period of extreme market growth. For months, global indices had been climbing on the back of two things: the promise of artificial intelligence and an insatiable demand for semiconductor chips. This chart shows the scale of that expansion. South Korean markets had nearly doubled in value, and the S&P 500 had seen 11 winning weeks out of the last 12, until that trajectory suddenly snapped. That long-running market expansion had been built on an increasingly thin foundation. June 23rd was the moment that those expectations finally collided with a set of shifting global data points. The selling began when investors started questioning whether AI valuations were priced for perfection, leaving no room for a slowdown in corporate adoption. The trigger point was the semiconductor industry in Asia. As investors moved to lock in profits, memory chip giants like Samsung and SK Hynix saw their stock prices dive by more than 12%. This exposed a massive concentration risk. Instead of a broad market recovery, a tiny group of mega-cap tech companies had been responsible for nearly all of the global market's gains. The turning point came from a surprising place: Accenture. When the firm lowered its annual revenue forecast, it provided the first hard evidence that global corporate spending on tech was actually starting to cool. The issue wasn't the technology itself, but the math. Financial expectations had accelerated far beyond the rate at which companies were actually adopting and paying for these AI tools. As the tech sector began to stumble, a separate shockwave emerged from the Middle East as the conflict between the US and Iran escalated. Shipping disruptions in the Strait of Hormuz immediately spiked the price of crude oil, which settled above $73 a barrel. This sudden energy shock reignited inflation worries. Higher fuel costs made shipping goods more expensive, reversing months of progress in cooling the global economy. In response to this data, the U.S. Federal Reserve signaled a more aggressive stance, suggesting that interest rates would need to stay higher for much longer than investors anticipated. Wall Street projections shifted almost instantly. Bank of America, which had expected rates to remain unchanged, suddenly pivoted to forecasting 3 separate rate hikes for 2026. This created an economic squeeze. The momentum of the tech boom was now facing the high cost of energy and the rising price of borrowing money. While U.S. markets grappled with those rates, the impact began to resonate internationally through a specific financial mechanism called capital flight. When the Federal Reserve raises rates, U.S. Treasury yields move higher. Offering a guaranteed return, these rising yields act like a magnet for global capital. They strengthen the U.S. dollar while draining liquidity